Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Shah and you're watching Indian Open. Let's go straight to the headlines at this hour. The US Federal Reserve hikes rates for the second time this year, signals at not one but two more hikes in 2018. Asian markets head lower, reacting to the hawkish stance taken by the world's most influential central bank. ICICI Bank gets set to sell 2% stake in its life insurance arm, ICICI Prudential, in keeping with regulatory norms. The Cabinet Committee on Economic Affairs clears HDFC Bank's proposal seeking a nod to raise an additional 24,000 crores of foreign direct investments. Well, straight to the big story of the day. The US Federal Reserve raised interest rates for a second time this year, just as expected. What changed, though, is the stance taken by the FOMC. It hinted at a hawkish approach towards the monetary policy and penciled in a fourth rate hike this year, which is a departure from what the market was expecting or has been expecting thus far. Kathleen Hayes of Bloomberg News first Johnson to tell us what this means for interest rates and the U.S. economy in the long run.
We got the 25 basis point rate hike as expected. No big deal. But it was a very small shift in the dots that hit the bond market, hit the stock market, is hitting Asian markets as well. People, I think, are still trying to figure it out. Dots go, DOTS on the terminal, tells you this story in pictures. You have 7 dots saying, I think we're probably going to need to hike rates 4 times this year. Those dots represent FOMC members. Now there's 5 that say, no, I think 3 is more like it. That had been evenly divided, 6 versus 6. Now, it's interesting. We had Roberto Perli on Bloomberg Television just a couple of hours ago. He was the Division of Monetary Affairs at the Fed's Board of Governors. Very important position, a lot to do with setting policy. Here's what he said about the shift in the dots.
It's not a solid signal. I would be inclined to think about it in terms of more noise than signal. I think what the Powell Fed will do is we'll look at the data and take his clues from there. But I think the dots are a little bit just an exercise in forecasting.
Now, it's true markets also saw some hawkishness in the change in the FOMC's outlook for the economy. A little bit stronger GDP, lower unemployment, inflation a little bit stronger. But I think people maybe should pay strong attention to what Jay Powell said at the press conference. He sees wide uncertainty bands around things like the natural rate of unemployment. Where's the neutral rate? The rate maybe would signal the Fed should stop or only go a little bit further. And he said the Fed policy will be guided by incoming data. We will try to keep our minds open. So maybe we're seeing a little more hawkishness, at least in the Fed chair, than is actually there.
Well, it's had a small impact, if you will, on the world markets by and large, but these things don't necessarily happen just now and immediately. It could happen a bit later on as well. And just as Kathleen said, stocks in Asia followed the U.S. equities lower after that hawkish statement. The dollar fell, treasury yields stabilized after briefly touching the 3% mark as well. But what does this whole scenario of more rate hikes than anticipated mean for global markets, more specifically emerging markets like India as well? Let's find out the global market picture and the emerging market picture from Adrian Mowat, veteran emerging market strategist who joins us from Hong Kong, and Geoffrey Dennis, head of global emerging market strategy at UBS Securities, who joins us from Boston. Gentlemen, both of you, very good morning or very good evening, as the case may be, to each of you. Thank you so much for taking the time out and speaking to us at Bloomberg Quint India. Adrian, let me start off with you. Did this come as a big surprise, or was there a lingering feeling that there will be a change from 3 to 4 this time around?
I don't think it did come as a big surprise. I was just looking through the stats in terms of what the futures markets was forecasting, and there doesn't seem to be a big change in what was forecast for where rates will be by the December meeting, let alone the January meeting. Perhaps it was the tone of the Fed in terms of their confidence that the rates would continue to rise and their optimistic statements around the economy that might have taken markets by surprise. I think there's also a dynamic here where, market confidence is relatively low. When you look across the performance of markets year to date, the US market's up a bit, China's up, but many other markets are weaker. Even the sectors that should be beneficiaries of higher rates, like banks, don't seem to be performing particularly well at the moment. So I think the markets perhaps are telling you a little bit more about their weakness rather than really indicating a change of view with regards to the Fed.
Geoffrey, Dennis, it's not just about the 2 hikes now, the mean rates that everybody expects in FY19 also, all of that signal towards, if not faster, then more rate hikes than what the market would have presumed. Is it essentially due to growth or due to also a belief that inflation is right around the corner? And therefore, what does it do to yields in the near term in the US?
I don't think it's because inflation is assumed to be right around the corner. I think what the Fed is doing is ensuring that they've got some insurance out there, if you like, in case inflation does pick up more than anticipated. But I think the key point is Adrian's got it absolutely right. I think the market was sort of hovering between 3 and 4 rate hikes this year. We at UBS had 4 rate hikes in our forecast. And frankly, we think the market has overreacted to this because at the end of the day, we haven't changed our interest rate forecast on the back of this. And I think, as I say, I think all the Fed is really doing is just telling the world that they are comfortable about what the economy is doing. The economy's clearly picked up, and they just want to be signaling clearly to the market that in the event that inflation does surprise to the upside, they would be willing to do more. But at the end of the day, as I say, our forecast is still that rates will have no different a peak than we thought they would have this morning. And so we fully expect this little bit of bearish sentiment here that's come out of this meeting to subside probably relatively quickly.
Interesting. Adrian, one thing that you got to give credit for to the Fed now, they're wanting to be a lot more open about what their thought process is. And maybe that's why this move to having a Q&A after each of the policy statements as well. Now, my question to you is, if indeed the Fed is preparing the markets well for what it would do, and if indeed the economic factors are the big reason behind the rate hikes as well, a rising U.S. economy, falling employment, etc., would all probably augur well for the equity markets. And if indeed the US markets are slated to do well, if they do, they will not do that in isolation, right? Emerging markets, by and large, would also follow suit.
Well, no, I think the story of 2018 is that emerging markets are not performing in line. There's a big divergence of performance across the emerging world. So some of the simple commodity-related markets, the Perus, the Colombias are doing very well. You've got okay performance out of China, although much of that happened in the month of January. And then if you go to the other extreme, you've got markets such as Indonesia, Turkey, the Philippines down double digits, and a market such as Turkey, particularly vulnerable to rising funding costs. And as the Fed moves rates higher, you see that funding costs are not just moving up in US dollars, they're moving up in other currencies. So, yes, I accept your point that a good US economy is broadly good for global capital markets. But then when you look at the specifics that you invest in, we've got a story where the tech-heavy markets of North Asia are doing okay. I think for China, there's an interesting divergence in forces at work there. You know, the Chinese economy looks okay, earnings look okay. But if you look as U.S. rates are moving higher, we're seeing monetary conditions in Hong Kong tighten, with HIBOR at a 10-year high. And that having a little bit of pressure on the Hong Kong Stock Exchange, where many of the Chinese companies are listed. So, yes, generally when the U.S. is doing well, that's good for global markets. But remember that the forces at work here are having a diverging effect across the emerging market asset class.
Right. Adrian, let me rephrase my question. I mean, what I meant to ask you was was that the belief at the start of the year was that if the rate hikes are faster than what people anticipate, then there will be carnage in the emerging markets, bond markets, and equity markets. And the developed market world and maybe the US will see substantial fund inflows. We've seen part of that playing out because of the underperformance of the emerging markets hitherto in the year. If indeed the US economy were to do well and the markets were to do well, will we not see carnage in the emerging market pack despite the differential in yields? That's my moot question. Part two also is that a lot of emerging markets have started raising their rates as well. India, case in point, Indonesia, case in point, China, case in point.
Yeah, so look, I think the word carnage is very dramatic. We have seen double-digit declines in a number of emerging market equity markets. There has been significant weakness in a few key currencies, where I look at what's been going on with the Turkish lira, the Indonesian rupiah. Let's also be conscious that the Indian rupee is only about 2% away from its all-time low versus the US dollar. So there's definitely pressure out there. And I think markets are probably quite a long way into discounting the impact of higher rates and a slightly stronger dollar. Now, whether that leads to more dramatic events, I think really we've two factors at work here. As you highlight, the global economy is relatively strong, which should be good for corporate profitability and their ability to service debt. However, this increase in interest rates and funding costs in EM combined with weaker currencies may mean that there are a few borrowers out there with mismatch with domestic revenue and international liabilities, and perhaps that's where you begin to see some of the strain.
Geoffrey, Dennis, one final question. Actually, two questions roll into one. This whole talk of this inverted yield curve and the historical signal that has given. Now, everybody's talking about September and the possibilities that if there is the hike in September, then we definitely see the inverted yield curve, if not already. And part two of my question is the ECB signals, the likely ECB signals today evening, and what that does in addition to what the Fed has already done.
Yeah, fine. Let me just add one thing to what Adrian said. I think the thing that you should add to the mix in terms of this conversation is that emerging markets do well when global growth is good, as long as the dollar is going down. And that's what we had in 2017. And that was a perfect cocktail for EM. Now we've got a more challenging dollar environment. Dollar's been going up. And so then what happens then is even though you've got stronger growth, as bond yields back up and as the dollar is stronger, what it does is allow investors to pick over some of these weaker markets. And that's exactly what's happened this year with the weakness in Turkey, more recently the weakness in Brazil, one or two markets getting challenged in Asia as well, India, Indonesia, as has been said. So I think we've got to bear in mind the dollar environment is very different. Our view at UBS is that the dollar will go down again later this year, which will create, in our opinion, a better environment for EM. On to your specific question, we're not particularly bothered about the inverted yield curve. I mean, typically when inverted yield curves really cause problems is when inflation really takes off, and that forces aggressive tightening by the Federal Reserve to really choke the economy off. That's not going to happen this time. Yes, the yield curve will flatten a bit more. Bond yields will stay relatively contained in our view, but you're going to see controlled tightening. So without there being a big spurt in inflation, you don't have an aggressive Fed tightening, and that doesn't therefore signal a recession, although clearly people are very worried about that. I get it. And on the ECB, we think the ECB is going to do nothing very much tomorrow. We think they're more likely to signal next meeting they'll extend QE for a while longer. But at the end of the day, we still think they'll start tapering around the end of the year, and we think they'll start to raise rates about the middle of 2018. And that gradual tightening at the margin of monetary policy in Europe is one of the things that we think will eventually bring the dollar down, and that's the sort of thing that will eventually suck money out of the U.S. market, perhaps elsewhere, and in that environment, emerging markets can make some sort of recovery.
Okay, gentlemen, really appreciate you taking this time this morning and this evening, respectively. Adrian, Mowat, Geoffrey, Dennis, thank you so much for taking the time out and speaking to us.
Thanks very much.
Well, those are two important voices and pretty much everything that you needed to know about the impact, the summation. Nothing too positive for the emerging markets, but carnage, maybe not so. Let's wait and watch. For now, almost all of the EMs are showing, or the Asian markets are showing, a small bit of a reaction to what is arguably the Fed committee outcome. I don't see any other reason for this, but it's a flattish reaction. It could be a reaction on any normal day and not necessarily because of what the Fed has signaled. Maybe we'll get to see this over a period of time. The SGX Nifty indicating a start which could be marginally in the red, nothing too untoward. Okay, two other pieces on First Word today. In fact, 25 years ago today, India's homegrown software services firm Infosys listed on the bourses. Established by 7 engineers, Infosys was then just beginning to make a mark on the global technology landscape. 25 years post that, since that time, it is the second largest IT company in India by market cap and one of the most watched and traded stocks in the equity markets. Why just India? It went on to be the first Indian company to list its ADRs on the New York Stock Exchange as well. Agam Vakil has put together Infosys' journey since listing as Infosys completes 25 years of its listed existence today. Agam, for almost everybody who's watched the stock, not just been a part of the company, it's been a special day, but tell us about the journey.
Neeraj, I imagine that back in the 90s, there will be very few conversations with respect to the equity markets and not have a mention of Infosys, especially TCS wasn't even listed back then. And we've had such a staggering run for this behemoth. And this years of 25-year-old journey, well, there are plenty of leaders that have taken Infosys forward in every step. And I'm going to go through this journey by the leadership force out here. And of course, we're going to start off with NRN. Now, this is the time when Infosys market cap went from 280 crores to as much as 24,700 crores. The market cap has grown 88 times under NRN. And even when it comes to something like your revenues, do remember that it also hit the market cap of 50,000 crores around the time of NRN. And well, that said, when it comes to your revenues, well, 73% CAGR in these 7 years with Narayan Murthy at the helm, where your revenues moved from 55 crores to as much as 2,600 crores. Do remember, operating margins were at its highest at around 29%. And well, coming up next for Nandan Nilekani, he has carried on the baton. Again, a lot of strength coming in. And again, the market cap has still continued to grow by as much as 4.5 times in that period under him. And well, yet another milestone, as you can see, hitting the market cap around 1 lakh crores under his, well, leadership. When it comes to revenues too, again, they did grow substantially, 40% CAGR when it comes to revenues under him, well, revenues hitting the 13,000 crore mark as well. So the 10,000 milestone was also covered in there. That said, we may have seen a little bit of temperance when it comes to, well, leadership under Chris Gopalakrishnan. Again, there's a common theme out here that with every new CEO, Infosys market cap moves up by another 50,000 crores, or at least hits the next 50,000 crore mark, as is, and by the way, Salil Parekh is very well on the way of there as well. But again, under Chris Gopalakrishnan, as you can see, well, the market cap did grow subdued 22% in comparison to its previous two leaders. Now, this is where things get interesting. Let's pull up TCS versus Infosys. It was from the time the TCS were listed, TCS and Infosys market cap well moved largely in tandem. It was only in early 2008 when TCS's market cap went considerably below the market cap of Infosys, and it was only in late of 2010 when once again TCS took over Infosys, and since then TCS has not looked back. So there has in fact been a substantial divergence between the market cap of TCS and Infosys. And this is crucial because I'm going to talk a little more about how these revenues have panned out. That said, when it comes to the revenue movement as well under Chris Gopalakrishnan, again, well, some sort of subduedness coming through. 19% CAGR all the same, and some might say that this is a very healthy growth. But in comparison to what we've seen in the previous two leaderships, well, this may be a little bit of a disappointment. And since then, we have started to see some problems emerge to a certain extent specific to Infosys, largely also when the industry had started, well, just about showing some amount of slackness. But under Shibulal as well, we did see the market cap move up to the mark of around 2 lakh crores. Well, as you can see, from 1.34 lakh crores to around 1.93 at the end of his term. In terms of growth, we didn't see too much. So when it comes to the CAGR of just around 11%, this was a time at which TCS's CAGR was at 30%, and that explains that big divergence coming through after 2010. Moving in, let's also take a look at Vishal Sikka's term as well, and that's where again we saw market capitalization move up. This was a relatively volatile term for not just Infosys but for the entire IT pack, where we started to see slackness in growth. And as you can see, it did hit the 2.5 lakh crore market cap, but eventually coming down to around 2 lakhs. And of course, around the time when Vishal Sikka had left, the stock also saw a substantial amount of volatility. Under Sikka, this was the first time that the revenue CAGR went below the double-digit mark, in fact coming down to as much as 7%, and in fact their operating margins also fell to around 25%, and the case hasn't improved in the near term. That said, when it comes to Salil Parekh, well, he has a very large responsibility to carry on, and he has suggested that he's going to take this 1 year to bring out the transformation that Infosys needs. Under him, we did see FY18 revenues at around 70,000 crores, though he really hasn't spent too much time in the CEO seat. But in terms of, well, your outlook as well, again, we're expecting a very subdued growth, about 6 to 8%, a lot less than a lot of its other peers are suggesting. But margins guidance at running 22 to 24%, that was also a little bit of disappointment. That said, this year and from here on, it's going to be all about transformation. And well, its largest peer, TCS, has suggested that they are already positioning themselves as the next generation services giant. We're going to have to wait and see what Infosys can do and how far it can carry their responsibilities as one of the foremost and leading information technology companies in India to make an impact all over the earth.
Well, let's wait and watch. It's been 25 glorious years, so to say, even though this decade has been a bit patchy compared to the others. But let's wait and watch what happens next. Can Salil Parekh bring back Infosys to its glory growth days? We'll wait and watch. Thanks, Agam, for putting this into perspective. We also speak to the man whose company arranged the Infosys listing all those years ago. A conversation with Vallabh Bhansali of Enam Group at 9:45 a.m. today. It's one in a lifetime. The World Cup comes once in 4 years, but it's as special, if not more. And well, more than 3 billion viewers tuning in last time around, and this time it is in Russia, and that makes it even more special. The FIFA World Cup 2018 kicks off in Moscow today. 32 teams are competing for the coveted title, and national pride's at stake. But here's a factoid: the prominent footballers earn a whole lot more from club football than playing for the nation. So who are the top 5 most valuable footballers playing this year, and who are the 5 who are not? Let's start off with the ones who are playing this year. Yash, good morning.
Good morning, Neeraj. So we'll start off with the 5th most valuable player, and at number 5 is Belgium's playmaker Kevin De Bruyne. He's had a fantastic season with Manchester City, where he has won the Premier League title and assisted 16 times. And now with the likes of Eden Hazard, Romelu Lukaku and Dries Mertens up front, surely we could expect Belgium to score a whole lot of goals in this time's campaign. At 4th place and tied in terms of value is Harry Kane. He is estimated to be worth about $181 million. Boasting of a young and a talented England side, Gareth Southgate's England are definitely one of the dark horses to win this year's campaign. The England striker has been in prolific form, scoring 30 goals for Tottenham Hotspurs in their successful campaign, which saw them finish 4th in the league. Now, with that and 13 goals in 24 caps for the Three Lions, Harry Kane is surely one of the most lethal attackers in the tournament and one to watch out for. But let's move on, and at number 3, we have the Egyptian Messi, Mohamed Salah. He too is estimated to be about $181 million. He's had a breakout campaign with Liverpool, following a €40 million move from AS Roma, where he managed to score the most number of goals in a Premier League season than any other player. Now, with that, he has single-handedly taken Egypt to their first ever World Cup since 1990. Having suffered a shoulder injury in the Champions League final last month, surely the Egyptian fans would be missing him out in the first 2 matches of the group stages. But on to the number 2 spot and the joint most valuable player, that is Lionel Messi. He is worth about $217 million. Now, he's had a dominating season with Barcelona, scoring 50 goals in all competition. Now, with 9 Spanish titles and 4 Champions League winners' medal, Lionel Messi is undoubtedly one of the greatest of all times, if not the best. But it is the form and the success at the national level that has eluded the 5-time Ballon d'Or winner. And for Argentina, it would be very important for him to replicate that form at the national level as well. And finally, we're looking at Brazil's Neymar. He too is estimated to be about a $217 million Now, he's had a successful first campaign with PSG, following a world record 222 million euro move from Barcelona. He scored 19 and assisted 13 times in the league with PSG, winning the title with 5 matches in hand. For Brazil, it would be his form and most importantly his fitness for them to go as far as they could in this year's campaign. But a small disclaimer, these are the values that transfer market has assigned to these players. They have a whole host of criteria such as the age, the performance of the player and the number of years pending on their contract. So if any of your favorite player does not feature on the list, well, that is the reason for it.
Okay, that's a standard disclaimer and a good one. Yeah, a lot of people would feel, why is it that we don't have some very popular players? Cristiano Ronaldo missing out here for sure. Some Uruguayan fans would also talk about Suarez. May not be in the most expensive league, but certainly out there in terms of the top footballers and the top strikers to watch out for. But if these are the ones which have made to the list, there are some other players whose market value is quite high, but they still haven't made it to their national teams. And that's a bit of a surprise, Yash.
Yeah, but that's given the fact that there's so much competition and the immense depth and talent that some of the top quality players, they have not made it to Russia. So at number 5 is France and PSG superstar Adrian Rabiot. He's a young 24-year player. He's worth about $60 million and a string of poor performances in the national colour and a dip in form towards the second half of the season saw the Frenchman not being selected for the season. Alvaro Morata, he's had a disappointing first campaign for Chelsea following a big money move from Real Madrid. A dip in form and a slew of injuries saw the Spaniard being sidelined. He managed to score only 11 times in the season and eventually lost out on his first team spot to Olivier Giroud. Now, keeping up with the French team in number 3 is Anthony Martial, the $78 million French attacker. Now, he's had a disappointing campaign with Manchester United after falling out of favor with manager Jose Mourinho and losing out on crucial game time following the signing of Alexis Sanchez from Arsenal. Because of this reason, he was dropped, but he would be a key player who would not be playing there. But the most important and the most crucial omission in this list has to be that of Manchester City's Leroy Sané. The young player of the year took the Manchester City team to their first Premier League title in 4 seasons and assisted 15 times, just one less than Kevin De Bruyne with 16. And now it would surely be a big shocker to not have such a young and talented player to be missing out on his flight to Russia. But it is Mauro Icardi who's the most valuable player who won't be making it to Russia. This is because of an immense pool of attackers that Argentina already has. They have the likes of Messi, Aguero and the Juventus duo of Higuain and Paulo Dybala. So probably his services won't be missed.
Interesting. Yash, thanks for putting all of that into perspective. I have one small question, Yash. Who is a bigger football fan, you or Agam? Be honest about it.
Given the number of years he's been watching football, I'd give to Agam.
Oh, wow, that's gracious of you. Thanks a lot for that, Yash. Okay, so that's, well, some football fans from our team who've been bringing you for the last 3 days what some of the most expensive players have done or not done. And well, what's made it to the list of the brokerages as well. The fiesta starts off today, so do stay tuned into all the updates, and we'll try and get you some of the updates right here on Bloomberg Quint as well, even though we are only focusing on business. But that's all that we have on First Word today. Lots more lined up as far as trade goes, as macro indicators point to a strengthening of the rural economy. We find out what it means for financiers like M&M Financial Services. Ramesh Iyer would be joining us on the show. And like we said, a very special conversation with Vallabh Bhansali of Enam Group on the journey of Infosys in the equity markets. But right after this break, we shift focus to the day's trade.
Welcome back. You're watching Indian Open. Well, the Asian markets are bearing downwards right now, considering the FOMC action that we saw overnight. And with that, we have some weakness in the Nikkei, Shanghai, as well as Hang Seng, as you can see on the screen. And we're looking at a 0.3% cut when it comes to the SGX Nifty as well. Currently, just a tad above 10,800. What can we expect from our own markets when it comes to the derivatives segment, and what kind of cues is that throwing in terms of expectations? Today we have Navneet Saluja joining us to give us an idea and an update. Good morning, Navneet.
Good morning, Agam. Well, I think we'll have to wait a little more for 10,900 for Nifty. In fact, in last 4 trading sessions, 2 out of the 4 trading sessions, Nifty has been giving up its highs that we've seen. And yesterday was one that case. Nifty futures almost closing flattish, as you can see, and the discount widened to almost 11 points versus 3 points, which was seen in the previous trading sessions. 3.5% higher when it comes to the open interest edition. But Bank Nifty is the one which is going to be in focus. It's Thursday. Today's the day for the options weekly expiry day. Here also the Nifty futures actually closed at a discount. Bank Nifty futures closed at a discount. If you're looking at a range for today's expiry, it could be anywhere between 26,400 on the downside to about maximum 27,000 on the upside. But yesterday there was a lot of writing seen around the 27,000 call. Volatility seems to be on the lower side, and actually that's been auguring very well for the markets. Yesterday also India VIX closed with some bit of cuts. But if you look at the Nifty PCI, that's another factor which is contributing to the higher levels, because the base now for the markets has moved higher. Nifty PCR went up to levels of 1.62. Bank Nifty PCR also was above the mark of 1 at about 1.04. Let's tell you which were the option strike which contributed to the higher PCI yesterday. There was a lot of put writing seen around the mark of 10,700, 10,800. Remember, maximum open interest for June series so far was at around 10,600 strike. Yesterday, that's moved to 10,700. So that's indicating the base actually has moved higher, but can we cross the 11,000 mark? That still remains to be seen. Institutions, there's building up some bit of long positions actually. This is index futures, so they're still net short on index future. If you look at this percentage, they did build up shorts here. But if you pull up the index options played, I've been observing in the last 3 sessions, they've been adding a lot of contracts here. Almost over 30,000 contracts in the last 3 sessions have been added. And yesterday they also added some bullish bets on the call long side. Finally, some stock futures to keep an eye on in today's session. Dish TV, Rare Enterprises bought 0.7% stake in the company. So we did see a lot of open interest build up. There were some block deals yesterday. Watch out for this one. The other stock to keep an eye would be RBL Bank. That touched 52-week high, so watch out. Fresh long positions were seen for this one too. And finally, ahead of that news which came yesterday in the evening, where ICICI is looking to sell 2% stake in ICICI Approved, that one saw fresh shots.
Okay. Thanks a lot for that, Vineet. We'll watch out for all of these, at least from a trade perspective. In fact, that would be one of the stocks to watch out for, ICICI Prudential. We'll talk about that with Parthiv Shah. He's director at TRACOM Stockbrokers, joins us right now on the show. Parthiv, good morning. Many thanks for joining in. Let's just start off, though, with the bigger newsmaker, and that is HDFC Bank. The clearance coming in, I'm cutting straight to the chase, Parthiv. We're about 25 minutes before the pre-open rates kick in. HDFC Bank, additional limits opened up. What do you make of all that's happening around this? Because the FI window is open, but not all has been bought in. Now there is another 24,000 crores worth of stock that would be available as well. What does all of this do to the HDFC Bank stock in the near term?
Good morning, Neeraj. Neeraj, yes, absolutely right. I think out of the 24,000, 8,000 crore would come from the kitty of HDFC Limited. And I think this is going to happen via QIP. I'm fairly confident that at this point in time, this particular 24,000 crore will be raised by HDFC Bank. And I think we know for the fact that this bank has a spectacular track record in terms of its capital allocation. Because in case of banks, I think the capital allocation is all about the advances that they make, the capital adequacy that they have, which will help them to give new loans. And I think the rate at which they've been growing, I think it's a fantastic point in time. Rather, I would say it's an inflection point in time wherein we are seeing the overall credit growth picking up in the economy. And HDFC Bank has a track record that they are always ahead of the curve in terms of whenever the economy has tended to pick up. I think their credit growth is almost 2.5 times the multiplier of the GDP. So I think they can even do better as per the management commentary last time. So this capital cushioning will be extremely important. And yes, I've been bullish on HDFC Bank for eternal number of years. And even from here, I feel if one wants to play the best bank of India, that would still be HDFC Bank. Even here, if one buys into the portfolio over the next 3 to 5 years, this will surely compound wealth in one's portfolio.
Okay, well, hold that thought, Parthiv. Let's just take account of all the stocks which will be in news today and several other broking calls which we've also had come through, and of course an analyst meet from some of these companies in which we have been holding. So we have a whole host of stocks that will be in focus today's Geoffrey. We have a research team joining us. Good morning, guys. Thanks for joining us. I'm going to start off with the stocks and news. Nikki, what do you have on your list?
I'm going to start off with a negative news where the proposal for amalgamation between Fortis Healthcare, Fortis Malhar and SR HRL has been withdrawn. Second on the list that we're tracking this morning is Cipla, which has apparently got, says that its African unit is exploring an option of IPO. Also separately, it has got an approval for one of its for one of its injection. Oberoi Realty QIP opens for subscription, and the floor price has been decided upon at 509, which is a discount of 3.5% as compared to the current market price. Hindustan National Gas is expected to sell around 11.3% stake in H&G Float Class joint venture, which is for a sum of around 125 odd crore. Also, we are tracking Z Entertainment. Now, this is an ET exclusive, which says that the Z and a Reliance broadcast deal could actually not be in place, or maybe just fall out over the price revision demand. Z announced the deal back in November 2016 for a price of around 1,872 crores. Sources says it wants to lower the price. Usha Martin is also in our list today. It is an ET news that we are tracking. Liberty Group and Kalyani have joined the race. Now, do remember, we already had Tata Steel and JSW Steel, which had apparently expressed their interest in the company. And last, we have saved the good for the last. I think Dish TV, that's Rakesh Jhunjhunwala, has bought a 0.7% stake in this counter for a sum of around 93 odd crore.
Okay, we also have Westlife Development, which had an analyst meet. What are the key takeaways here, Darshan?
Yeah, so Agam, what they did was they highlighted their vision 2022 and what they expect to be. So basically what they're targeting is a doubling of the revenue. So current revenues are almost close to 1,100 crores. So in the next 5 years, they expect revenues to be anywhere between 2,000 to 2,500 crores. That's the broad target that they have. The EBITDA margins, which are currently at 7.5%, they're planning to take it anywhere between 13 to 15% in the next 5 years. And mainly what they're looking at is SSSG in excess of 7 to 9%, and expanding the store count from 227 currently to anywhere between 400 to 500. So increasing SSSG, increasing the store count is something that will help them double their revenues and improve the margins. The other thing that they're looking at, apart from the normal store, is McCafe, which is doing well, and they expect a larger contribution to come in from there. And the delivery model is something that they're looking to boost significantly. That could incrementally help the store revenue. So these are the couple of factors that they're betting on. Doubling of revenue is something that they are expecting to happen over the next 5 years.
Right, and of course HDFC Bank will also be in focus on account of a clearance from the cabinet coming through. Shraddha?
That's correct. So their capital raise of 24,000 crores via FDI is what the cabinet has approved. This is not fresh capital, as in the plans for raising 24,000 crores were announced by the board last December itself. The move, of course, will be subject to a 74% cap for foreign shareholding. Finance Minister Piyush Goyal has said that post the issuance of this capital, the regulatory limit of 74% will be will be reached versus the current shareholding of about 72.78%. Do remember that HDFC Limited has put aside 8,500 crores to invest in HDFC Bank to maintain their current shareholding, which stands at about 21% as well. So not really a new development. It's the cabinet approval which has come in. Citi has said that they see the capital raise to be a positive trigger for the HDFC Bank stock. As at the current price, the stock trades at 5 times its FY18 price to book, and they believe that the capital raise would add about 240 basis points to the FY19 Tier 1 capital. Post the capital raise, they say that the bank's growth could accelerate even further because they're well placed to capture market gains. Hence, they maintain the buy with a target price of 2425. So how's the stock likely to react today? Well, while it could be sentimentally positive, if the ADR's reaction is anything to go by, we could see the stock opening lower. The HDFC Bank ADR's ended about 2.5%.
Right, fair enough. Of course, we've already discussed that with Parthiv. But thanks, guys, for joining us and giving us those details. But Parthiv, I'm going to address the quick service restaurant industry with you right now. We've had commentary coming in from Westlife Development. We've seen a lot of strength in Jubilant Foodworks as well. How are you playing this area now? Are you cautious with the way the valuations are panning out for some of these companies, or would you invest for the long term when it comes to something like a Westlife Development, or for that matter Jubilant Foodworks?
See, at current juncture, as compared to Jubilant Foods, I think I'm more keen to invest into Westlife Development. Setting aside a potential re-rating trigger, which is getting the franchisee rights for the North and the East, which at this juncture looks like, I think, a distant possibility because still there's a lot of cases and all pending. But still, I think there's a definite possibility that going ahead, if anyone else in the country were to get those franchisees, it could be Westlife Development. But nonetheless, I think their West and South regions are doing extremely well. And I think most importantly, the management is thinking very innovatively. Imagine, I think, how much of a real estate space they're able to save by having the QSR restaurant, which is the burgers, fries, etc., along with having cafe shops within that same real estate. And they've rechecked the entire shop. So I think it makes very, very good sense. It's a very smart move. And also they're continuously innovating. So I think that's always a good thing. And that always helps the SSG. We've seen the case in Jubilant Foods. Only once they started innovating, changing the recipe, etc., they saw a huge pickup in the SSG. And I think no doubt one key concern, especially in case of valuations for Westlife Development, is still it is generating single-digit EBITDA margins. No doubt the management is quite confident because currently they are in a capex mode, and once the store count increases and once the SSG also tends to grow, they will get that operating levers which will help them to reach that double-digit margin. But that's not going to happen anytime soon. That will take around 2021, 2022. But nonetheless, I think the volume growth does help the stock valuation, and this is one great play to play that consumption theme, and this is bound to grow unprecedentedly. I think this is a very, very big opportunity for players like McDonald's. They've shown it time and again in other emerging economies, and India is no exception. They will certainly do well here as well.
Interesting. Parthiv, you might think that I'm stuck with you on city gas distribution companies, but hey, HPCL Oil India have announced a potential JV for city gas distribution as well. Now, I'm not saying that this means there is immediate competition for the ones that are already there, but what do you make of this pack now? And because it's such a lucrative pack, we'll probably see more and more people making a beeline for this because the growth is out there for everybody to be taking. What would your view be on this particular development and on the currently listed players?
Neil, I was reading an article wherein even a player like MGL, Mahanagar Gas Limited, currently even in the pockets where they're operating, say for example, they're operating in Mumbai, there's still a huge untapped opportunity within the pockets that they're operating. Forget setting aside, the new pockets, the new regions that they've won, in which they're going to do almost 200 crore capex. So my point is, and my sense is that this is a huge opportunity in the entire country. I mean, if at all a place like UP were to get entire, I think, CGD distribution, that would itself be a humongous amount of capex and humongous amount of volume growth story. So what I feel is the current incumbents who have that first mover advantage will always have that advantage of being at the locations where they are at and expanding, plus winning the newer geographies. We'll have some private players like Adani Gas, which will get listed going ahead, which will get demerged from Adani Enterprises. But irrespective of the fact that HPCLs and the OMCs of the world who are cash rich would come into this particular foray, they will need good partners like MGL, Gujarat Gas, IGL, because I think they are already established players. They understand this business model in and out. So I think it's a great opportunity. And recently what we have seen, a player like MGL has corrected from its peak. The valuations are very comforting. They have increased the prices, which helps them helps them to kind of improve their margins as well, along with the volume growth which is already taking place. So I think at current juncture, if I were to bet on this city gas distribution play, my pick would be MGL. It's quoting at almost 20% discount to its peer like IGL. So I think Mahanagar Gas makes very good sense in the portfolio right now.
Okay, well, it's time to get in our technical experts at this point in time. We have Sameet Chavan, Chief Analyst for Technicals and Derivatives at Angel Broking. And we also have Rahul Mohindar, the Director at Viratech Software, joining us on the show. Gentlemen, good morning. Thanks for joining us. Rahul, over the past few weeks, whenever we've been speaking to you, you've been fairly constructive when it comes to the Nifty. Is it time to take a cautious stance considering the global cues, or would you still, suggest that there is some positivity coming through?
Good morning. First of all, I have been positive on the Nifty and still continue to be. I think there is no reason to immediately pull the trigger on the sell side. There is no immediate reason that I see that one needs to book out of it. If you're very worried about intraday short-term play, that's a separate story. But broadly speaking, we're well above 10,680. We're well above 10,540. These are two very important numbers on the downside. And particularly, I would not even review the trend unless we close below that 10,680 level. So I think if you have drops, let's say you open a percent soft or you move down a percent or two, there will be some buying that will come in. It's more stock specific play. And I think the bank nifty too, if I may add, looks fairly positive to me. There too, my view is a correction will be used by a lot of traders to continue to get in. So even at this point in time, keep 10,680 in mind. That's the only point. If that breaks on a close, before that, I don't think it's worth a review on the medium to long-term trend at all.
Sameet, Chavan, Neeraj here, good morning. How are you viewing trade? We'll start off slightly lower, but for long positions that are already existing, should people stay on or would you advise booking some profits?
Yes, one should stay, but if we look at the overall price movement in the last 4 to 5 trading sessions, we have been gradually moving higher after surpassing 10,780. Yes, after surpassing 10,780 last Thursday, we should have got some kind of momentum, but that momentum is clearly missing because the top 6 to 7 index affiliates like HDFC Twins, ICICI Bank, Reliance Industries, they are consolidating a bit and they have taken a backseat. But overall, if you see, this rally was mainly driven by beaten down mid-cap counters and especially the pharmaceutical space. So we believe that this positive bias is likely to continue. We are in a range wherein on the low side 10,780 would act as a very strong support. So as a trader, if you have a long position, you should place your stop loss now somewhere on 10,770 and hold on. On the higher side, 10,900, 10,920, these are the immediate levels to watch out for. So if you get a chance to book out your partial profits and 10,900, 10,920, probably these are the level wherein you should liquidate your longs partially.
Okay. Let's try and talk about stocks. Rahul, let me come to you first. What are a couple of ideas that people can play around with today? I mean, not be day trading ideas, but what are the stocks today to watch today?
Okay, well, considering that we will see a bit of a soft opening, or that's at least the expectation, my opinion would be that I'd like to lead with the heavyweights, use a decline in a stock like Reliance. So if we open, let's say, around the 990 odd mark, or even if we come intraday somewhere around anywhere in that pocket between 980 and 990, that's kind of a zone I'd like to buy it in. I clearly think Reliance is poised for newer highs. We've got a significant rally in place. It's above various averages. All the indicators are in fine fettle. Keeping all that in mind, 1035, that's my target. 1035 is my target on Reliance Industries. There's strong support around 965, 970. So keep a stop loss if it breaks 965. Use an opportunity around 990 to enter long on the stock. On the weak side of things, I still think Tata Steel, DLF, these are all stocks that can go down, but very specifically a strategy on Tata Steel. I think we'll once again move down to that 540, 545 zone. So that's a sell on my list. 572 would be my stop loss on Tata Steel.
Right, Sameet, how about you? What stocks are you betting on today?
We like Delta Corp. Recently, there was a massive correction in this counter from the higher levels of 360, 380. However, in the recent past, if I just look at the daily chart, it has been consolidating. It has been consolidating within the boundaries of falling wedge pattern. Yesterday, we witnessed a breakout from this pattern along with sizable volume. So this pattern has already occurred around its important support levels, and yesterday's price and volume activity indicate yes, the stock is poised for a decent up move, at least in the near term. So we would expect a decent move toward 270, which is our near term target. It can be bought with a stop loss of 229. Apart from this, we are liking cement space, especially Ambuja and ACC. They've already corrected significantly over the past 3 to 4 months, and they have reached their major support levels. Yesterday, yes, we saw good positive traction in this Ambuja cement, and if I look at the volume activity, it has picked up significantly in last couple of days. So I would expect a decent relief rally in these names. So Ambuja cement is one stock that is offering a good risk to reward ratio. So I would expect a target toward 220 for Ambuja. One can go long with a stop loss of 206.
Okay, then on to our special segment, Bloomberg Edge, where we have Jayesh Khilnani, who will tell us about a pattern that the Bloomberg terminal has thrown up on today. And Jayesh, good morning. What's on your radar today?
Morning, Agam. The stock on Bloomberg Edge today is Raymond. That is because recently the stock has bounced back from the 200-day moving average and is now approaching its 100 and 200-day moving averages. With that, what has happened is, as of yesterday's close, the moving average convergence divergence indicator has seen a positive crossover, indicating a buy signal on the cards. Let's first have a look at how the MACD indicator works and what are the conditions that you have to keep in mind. It's a momentum indicator which shows you the relationship between the 12-period exponential moving average and the 26-period exponential moving average as well. It plots the MACD line and the signal line. These are the two important lines that you have to watch out for, and you have to buy when the MACD line crosses above the signal line, and you sell when the MACD line crosses below the signal line. Let's have a look at the chart of Raymond and what has happened. Close to the 950 level over here, when during the end of May the stock was actually consolidating. This is where the 200-day moving average was in fact placed. It has bounced above that, and now it is facing resistance from the 100 and the 50-day moving average as well. The bottom panel shows you the MACD indicator, which clearly shows that the blue line has in fact crossed above the white line, which has given it a potential buy signal on the cards.
And is there a way by which we can backtest the probability of success here, Jayesh?
Yes, Agam. Backtesting results show that in the last 1 year, if you had bought all the indications given by MACD, net profit would be close to 50%.
All right, Jayesh, thanks for bringing us those details. We'll be watching out for Raymond and see how that does in trade today. But Parthiv, coming back to, the pharmaceutical space, we have news in Cipla, and I know that we've been talking comprehensively about the pharma pack in general, but Cipla specifically. One is that in terms of news, it's looking to list one of its Ugandan units in the IPO space. But that said, how are you viewing Cipla as against some of its other peers, which have been quite resilient over the past few days? What's your take on Cipla right now?
See, I think one reason where I think there was a lot of bullish stance on Cipla was related to its inhaler and respiratory pipeline. Yes, I think that was supposed to be something which would be a game changer for Cipla, especially once they had got that approval in the UK markets. Then we'd envisage that the same would happen in the European markets, the US markets, and over there we know for the fact that the pricing is quite good. There's limited competition, and Cipla would generate fantastic cash flows. But I think the stock tells it all. I think it's been a totally non-performer since a very, very long time, irrespective of these triggers, irrespective of the management talking quite well for the future business. And probably I think the markets are aware of something that probably I'm not. But yes, I think Cipla has been a total non-mover. It's been a very boring stock. From the pharma pack, I think I feel that there are other better options to choose from, which can, I think, create more wealth over the next 3 to 4 years. So case in point being a stock like Cadila Healthcare, which I would prefer over Cipla, purely on the fact that last quarterly results, I think they showed fantastic resilience at a point in time where most of the other pharma companies, which are US-centric, were losing on the pricing pressure. Plus, I think it's not the end of the story for Cadila. They still have fantastic pipeline. They have lots of ANDAs to be filed, and out of those ANDAs, there are some drugs which will have very limited competition. So there's a lot of good visibility over the next 2 years for a company like Cadila, and it seems that the worst is over in the entire pharmaceutical pack, where we are seeing again that buying interest coming from institutional investors. And in that case in point, I think Cadila will be one of the most preferred bet. The promoter is holding almost 75%, so the free float relatively in the market is less, so that is always helpful. But yes, I think as compared to Cipla, any day I would prefer Cadila Healthcare at current juncture.
Couple of stocks that we should discuss. One of them is Infosys, yes, but before that, Page Industries. Now, the management was in conversation with Agam and Yatin yesterday as well on the jockey franchisee getting extended to 2040, and the behemoth moved up another 4%. You don't normally see, stocks moving like that without reason. So there was reason, therefore, yesterday in Page Industries. And Parthiv, that's the question really. Expensive valuations, yes, but the visibility now gets extended to a time frame which is beyond most investors' time frame any which way. So there is comfort on the franchisee for Page Industries for sure. Does that alone give you the comfort to go out and buy this, or are the valuations a tad too expensive?
See, frankly, Neeraj, how would I'd put Page Industries as what Maruti is in passenger vehicles, what ITC is in cigarette business. Same is the case with Page Industries. I think, yes, this gives a fantastic visibility in terms of the license renegotiation right up to 2040, which is very, very soothing to many of the long-term investors. And yes, I think to full credit of the management of Page Industries, they have never ever let down Jockey or Speedo, both the brands that they're catering to. And rather, I think probably going ahead in time, I won't be surprised if they use this Indian partner to take them to some other Southeast Asian countries because they've done a fantastic job. And the good thing to know about Page Industries as a company is they are looking to diversify. So I think they have a very strong brand, they have a strong distribution channel network, they're looking to diversify. But yes, absolutely right, Neeraj, I think the valuations always looking stretched, yet the stock tends to get re-rated. So for such stocks, I think my advice for here, I think especially for investors who have never ever bet on this stock, a great strategy would be doing a systematic investment plan. Just buy this stock every month whenever one sees any sort of decline, 3%, 5%, and keep on adding to your portfolio in a staggering manner, because timing this stock at current juncture, especially with the valuation so rich, and if at all it were to miss even one quarter due to raw material pricing or etc., whatever reasons, then the stock could correct 5-10%. So I think a good strategy from here would be doing an SIP in the stock. But yes, we are still bullish on this story. Over the next 5-10 years, I don't see any disruption here in this business model. So over the next 5-10 years, I think this stock can still create further value.
Okay, we just have about 2 minutes left for pre-open, so I'm going to address the two IT giants. Let's take up TCS first. It's been up and about after the buyback news. Rahul, are you tracking TCS? And what's your view here? Is it likely to move further up?
We are very bullish on technology, right from Tech Mahindra, which, we took a call on several weeks ago. TCS too is no exception. If you're looking at short-term gains, about 1860 is, on the cards. That's what we're looking at, but that's a very small run that we're looking. Of course, the stock has been an outperformer to the entire market. If you look at the last 1 year's performance, it's been quite fascinating. So I think in such a situation, it's hard to tell somebody to, go out and buy the stock now unless you're short-term trading. But definitely what I could recommend is for those of y'all who are long, or for those of y'all who are attempting to even enter long, the support levels are somewhere logged in between 1740 to 1750. And one can see a lot of volume also that's consolidated at that level. There's been a lot of price action, volume action at that level. So whatever you do, bear in mind that 1740 is the key level on the downside. Continue to hold the stock, continue to buy the stock. We should move closer to that 1860, 1880 level.
All right, we just have about 30 seconds left. But Sameet, what's your view on Infosys right now? More strength coming through?
See, there has been no stopping for this counter. Yeah, although, the momentum is lacking, but if you see last 3 weeks, this stock has been, gradually moving higher from the levels of, 1170, 1180, which was the earlier resistance zone. So as far as near-term levels are concerned, 1300, 1320, these are the next levels to watch out for. And on the lower side, support would now be seen somewhere around 1250, 1245.
Okay, hold that thought. Well, we're going to address the pre-open rates right now, which should come up on your screens any moment. For now, as it seems, we're looking at a positive tick for the Sensex, and it's the same for the Nifty 50. So it seems that as of now, some of these benchmark indices are disregarding what the global cues. Moving in, let's address and see how HDFC Bank is opening up. That's after the cabinet nod for the FDI investment coming through, and well, an 8% uptick. There you have it. We do remember that HDFC Bank has been relatively subdued over the previous few days, and we're looking at a likely strong opening in today's Geoffrey. Cipla is the other one, looking to list its Ugandan unit, and we have an uptick of 2% there as well. It's been resilient, but not as much as some of its other peers over the previous few days. Z Entertainment will also be in focus over its buying stake in RBNL, and we expect that there could be a price revision. Let's bring up Z Entertainment and see how that's opening in trade. It remains unchanged for now. We're going to have to wait for more time before we can start seeing some rates come through. And HPCL along with Oil India, if we can bring up both those stocks, are planning a foray into city gas distribution through a JV. Oil India is looking at an uptick around 3%. HPCL subdued Qs coming in. And with that, I'm going to just pull out TCS as well. So let's see how that's faring in trade. We did see a lot of strength yesterday. It's likely to continue upwards, up as much as 3%. And finally, Infosys, at its 25th anniversary of being a listed stock, well, it's looking at a decline of as much as 0.4%, but we're not sure. We're going to wait for some of these rates to stabilize and settle down, currently at around 1270, Neeraj.
Well, 1% beverage is an interesting trade there. Looks like starting off 5% higher. Let's wait and watch what happens there. Remember, the last 15 odd days, there have been about a crore and a half shares which have been marked for delivery. So some bit of buying has certainly happened in 1% beverages. I'm not sure of the exact number, but somewhere around there. So somebody's bought it in the last few days. Let's wait and watch though what happens to this one. There is CG Power, which is up about 4%. I want to see what ICICI Prudential Life Insurance is up to in today's session. Is it starting off with a small tick of red? Let's wait and watch. Yeah, about a couple of percentage points lower, so 399 and counting. And stocks which are trading at new highs yesterday, Page Industries, Britannia, and Firstsource, some strong moves for each of these yesterday. Let's see what they do today. Not necessarily that they'll move in the same vein, but stronger stocks continue to do well these days, and looks like they are all starting off on a good note as well. We'll get some chart checks going on these as well in a bit. But first, a couple of research pieces from the Bloomberg Quint recent site. First, Sameet Sarkar Johnson with the top brokerage calls of the day. Sameet, seems like people are, or brokerages are betting on select financial names.
Yes, they are. Now we have today two financial companies where the brokerage have initiated coverage. Now the first one is Edelweiss on Aditya Birla Capital. Now they have initiated coverage with a buy rating and a target price of 199, which suggests a potential upside of more than 42%. Now according to the brokerage, Aditya Birla Capital is in a sweet spot to capture the financialization story of India. Now, the brokerage says that there are multiple levers to sustain best-in-class growth and improve return ratios for the company. The company has a promising blend of different businesses which include the likes of the asset management company, non-banking financial company, housing finance company, and a life and health insurance. Now these businesses are scalable and also have a sustainable model according to the brokerage. Now the brokerage also says that the business model of Aditya Birla Capital shares the similarities of the successful financial entities like Bajaj Finance and HDFC. Lastly, it is expecting the company's EPS to grow at a compounded annual growth rate of 30% over FY18 to FY20, and says that execution of business strategy is the key risk to potential valuation re-rating when it comes to Aditya Birla Capital. Second, we have a CLSA on ICICI Securities. Now the brokerage has initiated coverage with a buy rating and a target price of 520, which suggests a potential upside of 46%. Now according to the brokerage, ICICI Securities benefits from financialization of household savings and from its parent ICICI Bank's brand and reach. Now among the company's businesses, the distribution and margin financing segment is expected to drive the revenue expansion for the brokerage, while the broking segment is expected to remain subdued. Now the brokerage is expecting the company's revenue and net profit to grow at a compounded annual growth rate of 17% and 21% over FY18 to FY21. Now the revenue is expected to grow on the back of expanding client base and increasing wallet share of customers, while the profit is expected to grow on the back of operating efficiencies. Lastly, the brokerage says that the dividend yield of ICICI Securities is one of the highest among the Nifty companies, and the company still trades as a discount to global peers.
Thanks, Thomas, for bringing us those details. We'll be watching out for two of those companies from the financial services space. But moving on, the country's three largest fund houses have put out their portfolio rejigs done in May. So let's start off with the largest. We have Jayesh Khilnani once again joining us to tell us about ICICI Prudential Mutual Fund and what that has bought and sold last month. Jayesh?
So Agam, first and foremost, they now have equity assets worth 1.17 lakh crores, which are invested in more than 600 securities. Now, if you look at the sector-wise composition, financials leads the way with about 24% allocation towards financials, and surprised by the utility space, they have about 10%, and that will be visible when the chart comes up on the screen, where they have increased their position. If we have a look at that, so they have NTPC and Tata Power. NTPC, they've bought about 3.2 crore shares, and Tata Power, they've bought about 2.3 crore shares. Now, I remember that a few weeks back, Ramesh had actually come on the mutual fund show and had spoken about utilities as a contra call. So definitely, they are actually buying into the utility space. ONGC, the other name that features on the list, 2.9 crore shares they've added over there. Idea Cellular and Wipro from the IT pack, that they have increased their stake. In terms of where they have decreased stake, Bharat 22 ETF, they have sold more than 10 crore units of that passive investment, followed by Power Grid, 7.5 crore shares. ICICI Bank, now this is the interesting one, because yesterday we saw that HDFC Mutual Fund as well as Aditya Birla Sun Life Mutual Fund have also reduced stake in ICICI Bank, and so did ICICI Prudential as well. Now, IDFC, the other counter, and Dabur from the FMCG space, they have reduced by about 46 lakh shares. In terms of the new buying and complete sell-offs that they have, if we can have that on the screen. So they have actually invested, or a first-time investment into the InvIT, which they have purchased about 1 crore units over there. Triveni Engineering makes its way into the portfolio of ICICI Prudential, 8 lakh shares they've purchased. Orient Refractories, 1.1 lakh shares, and GMC Projects also about 53,000 shares they've purchased. In terms of the complete sell-offs, there's only one counter, which is HDFC Standard Life. They held about 78,000 odd shares, which completely goes out of the portfolio of ICICI Prudential MF.
Wow, that's interesting. Thanks a lot for that, Jayesh. So do watch out for some of these names. I mean, a lot of people track what mutual fund houses are doing in order to figure out what the thought process might be of some of the marquee fund managers. This is a good way to do it. Watch some of the pieces that Jayesh does in and around this time of the month. Parthiv, life insurance in news as well. I mean, not just because of what's happened in the fund action, but ICICI Bank looking to sell about the 2% stake in ICICI Prudential. That brings about a temporary dip in the stock price, as we all know, likely to happen in ICICI Pru's case now as well. It comes back, therefore, to the price that it was at before it declared that fabulous set of numbers and showed a bit of a rally. What do you do here between the 3 or 4 or 5 listed insurance plays? All of them are large plays. There is safety and liquidity present in all of those. Which one would you choose? And what's your view on ICICI Pru individually as well?
See, firstly on ICICI Pru, I think this offer for sale gives a fantastic opportunity to again enter the stock at a decent correction. Luckily, the floor price is 5% lower than the previous close, so which is always a good thing. I'm very, very confident there will be fantastic demand for this 2% stake that ICICI Bank is shelling out. And I think, frankly speaking, no doubt, if we were to look into the last quarterly growth, because of a very huge year-on-year base effect, the growth seems to be in negative. But I think once this base effect pans out, I think we'll again see the growth normalizing. But more importantly, I think this was a company which used to do around 8-9% margins. Now, especially with more and more focus in the protection business, adopting more and more technology, they've come to that 16-16.5% sort of a margin band. Still far off from what HDFC Life does, which is at around 23% types. But I think nonetheless, there is a huge valuation gap, especially in terms of price to embedded value between HDFC Life and ICICI. So I think what we have been suggesting is one should play this theme. It's a fantastic story going ahead. The protection gap in a country like India is huge as compared to what is there in China. And also, if I were to talk about that inflection point about per capita GDP, which is touched $2,000, which is a very significant number for many countries where we've seen after this number, there has been an unprecedented growth in the life insurance guys. So overall, I think both the plays, HDFC Life and ICICI Life, are the two preferred picks out of all the listed stocks. And I think currently purely on valuation front and even in a short to medium term sort of a bounce back, I feel ICICI Pru is a very good entry point from here.
Okay, stay on, gentlemen. Minutes away from the market open. Let's tell you all that you need to know to stay ahead in trade today. HDFC Bank gets the cabinet nod to raise additional share capital up to a maximum of 24,000 crore rupees.
And that's not all. There's more news from the BFSI space. ICICI Bank to sell up to 2% stake in ICICI Prudential Life Insurance through stock exchange mechanism.
And what's Rakesh Jhunjhunwala's latest bet? Dish TV, Jhunjhunwala's investment arm Rare Enterprises buys 0.7% stake in the DTH service provider via block deals yesterday.
And coming to some key brokerage calls, CLSA sees 46% upside in ICICI Securities, while Edelweiss initiates coverage on AB Capital, forecasting an upside potential of 42.5%.
Here's more from the brokerages. Citi downgrades Mindtree to a sell, indicating that valuations are sector leading, which does not leave room for disappointment.
And in a fundraising exercise, Oberoi Realty launches QIP to raise 1,200 crore rupees with a floor price of 509.3 rupees per share.
Well, some interesting names out there. Sameet, I want to come to you first on Dish TV. Some tailwinds out there, some block deals happened yesterday, marquee names, Rakesh Jhunjhunwala being one. I think Amansa and some of the others too chipped in with some purchases. What do the charts of Dish TV look like?
See, this stock has been one of the underperforming stocks since last 8 to 10 months. If I just look at the recent price action, this stock has been consolidating. 68, 70 seems to be a support level, whereas on the higher side, 76 is the resistance. Yes, yesterday we saw this stock giving a good spike along with sizable volumes. But overall, if I see, I'll rather wait for a breakout to happen beyond 76 on a closing basis. Yesterday it did cross that level, but on intraday basis, eventually it came off a bit. But I would rather wait for a breakout to happen on a closing basis. If that happens, then yes, we could see a move towards 81, 82. Till then, I would expect continuation of this consolidation.
Oberoi Realty is the other company which is in focus right now. While we have seen a lot of strength on a year-to-date basis as well as in 1 year, and it's also one of the relatively fundamentally sound companies when it comes to realty space. But Rahul, if I were to take a technical call on this one, how are you viewing trade on Oberoi Realty right now, currently at around 527?
I'm still positive on Oberoi Realty. I think despite the big rally that we've seen right from 2017 lows of about 250 to 40, I think we've had a nice big run up, but that does not in any way break down the trend. If you look at all the down moves that have happened in the stock, they've really been corrective in nature, and I think this time it's again no exception. We've had this drop from about 610 odd levels. We've not had the drop with escalating volumes. We've not broken the 200-day average. We've not broken a lot of key moving averages or indicators. So keeping everything in mind, I would say that unless we break 490, do not review the trend of the stock. Continue to hold the stock. Could you buy it at present levels? Yes, you could even buy it at present levels with that 490 stop loss. I expect tremendous resistance once again closer to 580.
Okay, it's not just Oberoi Realty, but also Sobha, which is at least starting today's day of trade with some amount of weakness. I'm going to address that, but before we do that, we just have about a minute left. So I'm going to take some of those stock calls for today's day of trade. So Rahul, coming back to you, what's the big call for today?
Well, I look at two stocks. One is BPCL, the second is SBI. And as Jayesh was talking about the MACD, the weekly MACD on both these stocks have turned up, and they've both rested at their 200-day moving average and turned up. So big, medium to long-term signals. It may not necessarily be an intraday move, but again, even if you look at the daily or the intraday charts, any decline on these stocks are worth getting into. I don't think you're really going to be a big loser if you get in at these points.
And Sameet, what stock are you betting on? We just have about 30 seconds left.
I'll stick to Delta. After 6 months, the stock has come out of its concession zone and showing signs. Whenever the stock moves, we all know that it gives a good rally. So I would expect a decent rally toward 270, go along with the stop loss of 229.
Okay, 3 stocks, not just 2. Gentlemen, Rahul, Mohindar, Sameet, Chavan, thank you so much for joining us today and giving us your thoughts. Really, really appreciate your time this morning. And here's the market open for you. We'll start off marginally lower. The question mark only is, will we stay that way or will we bounce back, because the underlying trend thus far the last few days has been positive. No big shakes, just about 1/3% for the Nifty. The Nifty Bank, less than that, actually just 0.2%. Bring up the mid caps and the small caps and see what's happening there. Yeah, a flattish start, so no big shakeouts out of what the Fed announcement was yesterday. The faster or the more rate hikes is not really deterring the markets, though the ticks by and large are red. Infosys on the 25th anniversary birthday, whatever you call it, is down about a couple of percentage points. And that aside, no big cuts. Heavyweights like Reliance, ITC, SBI, all of them are soft. We don't have too many gainers, but for pharma, to be honest, Lupin, Cipla, Dr. Reddy's, that's more a trade pattern rather than any stock-specific news. HDFC Bank marginally higher, so that's one heavyweight which is doing rather well for itself. But aside of that, not too many stocks. Infosys is top loser, down about a couple of percentage points in the session today. I want to bring up ICICI Prudential and just see what that stock is doing in the session today. 8 rupees down, about 402. Remember, ICICI Bank to sell about 2% stake in ICICI Prudential. That stock starts off about a couple of percentage points lower. And some brokerage notes that have come out on a couple of stocks. Edelweiss initiated a buy on AB Capital. The target price was 190. The stock starts off marginally higher. And there's CLSA, which has initiated a buy on ICICI Securities. And that stock has started off about a couple of percentage points higher. So not bad start for these brokerage names in the session today. Last but not the least, a set of stocks which which hit new highs in trade yesterday. Just want to see how they are starting off today. So Page Industries, Britannia, and First Source, none of them really making a big mark on open. Let's wait and watch what happens there. The Nifty 52 now about 1/3 of a percentage point lower in trade. Agam, what are you spotting?
Reversals from the previous few days. We have the likes of Vakrangi, Quality, JBF Industries, PC Jeweler, all these stocks which were substantially weak last week are looking at an uptick right now. So there you have it, Vakrangi and PC Jeweler. Quality as well is trending higher, and it's the same for Manpasand Beverages, and JBF Industries is the other stock which is doing well in trade. On the losing end, we have a substantial weakness in Jagran Prakashan, as a matter of fact, which is the biggest loser on the Nifty 500 right now, down 7%. That's followed by Sri Renuka Sugars. That's also looking at substantial weakness, inching back towards a mark of 15 rupees per share. NBCC India as well seeing weakness, down 2.5%, along with Mahanagar Tele, that's of course the MTNL, and of course Marks and Pharma showing a decline of around 2% on the whole. Can we pull out Oberoi Realty and see how that's shaping up right now, considering its QIP? It's down as much as 1.8%. And the other one I wanted to address was ICICI Prudential. Again, we are likely to see some weakness coming through, and there you have it, about 2% decline on that one.
Yeah, so no big shakes though, but the stock starting off slightly lower in trade. Parthiv Shah, before we thank you, we haven't asked you about a company today that you would be looking out to invest in. We do that almost every single week. I don't know if the names have changed. You can reiterate an earlier name as well. But what is it that you're looking to do if you had money to invest in right now?
See, Neeraj, to be very honest, I think after this recent run-up and many of the favorite mid-caps which were down and have again come back to their all-time highs, or maybe close to the all-time highs. But still there's one stock which I feel, especially in the auto ancillary space, the name is Sandhar Technologies. We know it's a recent IPO. The good thing that I like about this company is visibility, and they are into various things which cater to the two-wheeler systems, the CV segments, and also the construction equipment, and especially they have a very good market share in the locking systems that they supply to the two-wheeler space. And we have seen the volume growth. They have been fantastic. The rural growth story is good, so demand is going to be good. And the good thing is that the management did indicate that over the last 5 years they have done a capex of almost 500 crores. The asset turns from it could be at least 2.5 times, so which gives visibility of adding almost additional 1,000 crores of top line. And the management is quite upbeat that this particular addition in terms of the top line will come into many capex that they have done, which is into value added. So I think there'll be some sort of margin expansion going ahead, which bodes extremely well. And I think there's a lot of visibility that over the next 3 years they can grow their margins, plus they can grow their profitability by almost around 30%, along with the growth in the top line that I suggested. So I think this is one space where I think auto ancillary is still a huge potential, and Sandhar Technologies is a stock that I like in this space.
Okay, Parthiv, we'll leave it at that. Thanks for joining us and giving us your views on the markets. And with that, we'll move across to another market voice. We have Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, who's joining us on the show. Mihir, good morning and thanks for joining us. Let me just start off with the various central bank actions that we've seen across the globe as well as in India. Based on the interest rate trajectory in the US, which is likely to, to a certain extent, influence the way markets pan out abroad. And, India, of course, what have you made of the commentary from the MPC? If you take both these into consideration, how are you likely to see equity markets pan out based on the influence of both?
Good morning. Yes, it's very clear that globally the best of the liquidity boom or liquidity wave that we saw over the last 8-9 years is over. Most of the central banks have demonstrated that even without inflation, growth is happening, and to that extent, they are trying to preempt any further inflation spike because unemployment is running at a really low level in the US especially, and in India we have the MPC minutes which were quite hawkish, and we also have a situation where growth is coming back to normal, and with oil prices at a certain level, the inflation targeting is a priority. Similarly, the ECB is also indicated that the best of the liquidity and the QE steps that they have taken are past us. So I think there's a little bit of a liquidity headwind coming over onto the emerging markets. We have seen emerging market equity flows negative over the past many weeks. Though in India the local liquidity is still sustaining the markets, but yes, there will be volatile times ahead given that the best is over in terms of the liquidity glut.
Okay, Mihir, so let me address the banking sector then. How are you viewing this sector? And I want to talk about the private sector specifically in this case. How are you looking at trade when it comes to ICICI Bank, Axis Bank? And I understand you can't talk about some of these names specifically, but as a group, what's your call on some of these large cap private banks right now?
So as far as the private banks are concerned, in times of rising interest rates, banks with a good liability franchise, a good deposit franchise should do well. And on the other side, on the pricing side, the public sector banks, a lot of them are in the PCA. They are not growing their books because they don't have the capital, etc. They're still grappling with the NPA issues. So the capitalization of the PSU banking sector, which is still about 65 to 70% of the system, is inadequate, and they will not be able to grow. So if the GDP has to grow at 7% or 7+%, then that credit will be supplied by the private sector banks. Given that, pricing power on the private sector banks should continue to remain, and as I mentioned, banks with good deposit, good liability base, with a good pricing power should continue to grow much faster than the system. So I don't see a problem with the private banks in general because of the pricing power and the rapid growth that they are able to demonstrate. You might see a little bit of squeeze on the wholesale borrowers like NBFCs, but there again, the better managed NBFCs will be able to pass on the costs.
All right. In that case, how are you dealing with NBFCs? Now, again, what we've noticed is while we've seen so much strength in the likes of Bajaj Finserv, Bajaj Finance, the relatively larger ones, the relatively smaller ones, at least in terms of the Bloomberg consensus, still to catch up. And there are, at least according to the consensus, a lot of opportunities there. Are you of the same opinion, or would you like to stay with the relatively larger ones?
So it has to be looked at from a company to company point of view. We can't really make general statements because each company has its own niche. There are companies which are into small ticket housing loans. There are companies which are focusing more on SME. There are companies on large ticket housing loans, truck finance companies, used truck finance companies. So NBFCs are not a homogeneous pack. They are a heterogeneous pack with different models. So we have to look at it on a case by case basis. We have seen reports that on some of the segments like very small ticket housing loans, there is stress. Probably not so great growth on the used truck market. That's what we've heard. But we're not really taking a blanket call. But in general, amongst the larger ones, we don't see valuations as being very attractive, and that's the reason why in our portfolios we are a bit underweight there.
Mihir, good morning. Neeraj here. Does the Fed commentary and likely what the ECB might indicate today evening as well give any discomfort about liquidity flows into emerging markets? I know the domestics are right up there when it comes to India, but if indeed the liquidity outflows from other emerging markets were to impact them, then India will not be a spot which shines out on its own, right? What's the sense that you're getting in terms of the comfort of on the liquidity front because of what the global central banks are doing?
So as we discussed, the best of the liquidity flows globally is over, and the Fed has done nothing unpredictable. There was a clear indication that they will hike, and it looks like there'll be a couple of more hikes for the rest of the year. So we have seen liquidity flows both in equity and fixed income slow down over the last many months for India, and that trend is probably likely to continue. So the key for us is to see how well the locals continue to put money into the mutual funds and the insurance companies, because even as of now, as we speak, there are no other options, frankly. Real estate, gold, etc. are not doing that well. So the key basically is the local investor.
Actually, on that topic, I'm glad you're with us today. The last month's data seems to suggest that balanced funds have seen significant outflows. The tax incentive kind of going away have consequently posed these changes. The ULIPs seen more inflows than what would otherwise have been the case. Do you sense that?
We haven't seen any major disruption in the pattern, frankly. Okay. I really need to take a look at it, but at least from my flows, I don't see any major change in the patterns.
Fair call. Now, you gave us a sense of what would you be doing on the largest space, which is banks and financials. What about the exporters? I see at least 3 asset management companies launch healthcare funds, which gives us an indication of what a certain sect of the market is thinking about one exporting pack, which is pharma. IT's been on a run now for the last 8 or 9 odd months. How are you positioning yourself on these two?
Sure. So we used to be underweight in these segments, and now we are minorly overweight. A couple of reasons. One is that the US economy doing very well does provide an incentive to go back into the IT pack, and we have seen decent traction on some of the companies which have been focusing on the US markets. Second is the currency, of course. With oil going up, there is a currency tailwind for exporters, so that of course is another factor. And on the pharma segment, the companies have been facing trouble for almost 3 years now, over 3 years now. And these issues are company specific, plant by plant issues, which now they have, over the last 2-3 years, again, they've put in the investments, got in the consultants, improved the processes, tried to fix the problem. So these are problems, as we've been discussing, these are problems which are not unfixable. It's just a question of management focus and willingness to do it. And in the last few months, we have seen one by one facilities getting approved by the FDA, all the warning letters, etc., gradually beginning to get withdrawn. So probably as far as the manufacturing issues are concerned, the worst is over in the pharma sector, and company by company, plant by plant, over the next 2 to 3 years, we will see them coming back on stream. However, the pricing pressure in generics still continues. So we may not see the kind of peak earnings that we saw and the peak margins that we saw coming back very soon, but definitely there will be an uptick in the sector in the next few years.
Okay, well, Mihir, Vora, we leave it at that. Thanks so much for joining us and giving us your outlook on the markets as well as the several sectors and how they can be played. We'll be watching out for some of those sectors that Mihir has spoken about, but we're going to slip into a short break. But on the other side of the break, as macro indicators point to strengthening of the rural economy, we find out what it means for financials like M&M Financial Services with Ramesh Iyer, who will be joining us soon on the show, and a conversation with Vallabh Bansali of Enam Group on Infosys' journey in the equity markets. Stay tuned in, lots more lined up.
Okay, you're back with us on Indian Open and on Bloomberg Quint. Okay, two special discussions. Two successive normal monsoons and government's focus on rural spending are showing results. Macro indicators show an undeniable strengthening of the rural economy. This in turn has helped rural financiers as well. Mahindra Financial Services, well, one of the largest ones out there, most levered to the rural India as well, is witnessing, I wouldn't say a turnaround, but a substantial growth in asset quality as well. So will the higher demand for tractors, trucks, continue to aid the company's finances, and is that all, or is there more in store? Let's talk to Ramesh Iyer, Managing Director at M&M Financial Services, joins us in our studios. Ramesh, so good having you. Thank you so much for taking the time out.
Thank you.
I wanted to ask this to you for quite some time now. This strength that everybody is talking about in the rural economy, do you personally get a sense that it is a factor of necessarily only election spending in an election year, or is this something that could last well beyond May 2019 as well, albeit the percentages may vary, but the strength, the underlying strength could last, monsoons being kind enough to us?
So, I mean, if you kind of look at what are the products, at least that we are financing, and what are the use of these products, they are not aspirational. They are really need-based products. Now, when things aren't so very well, maybe people could decide to delay their purchase decision, or they may say, let me use what I have for some more time. But once they see that the fundamentals are getting better, and then they reach out to start buying, because they put in 25% margin money of their own funds. And why will somebody invest if they don't see, let's say, at least a next 3 to 5 year kind of a story panning out for themselves? Right, so when we kind of look at products, whether you look at tractors, you look at UVs, you look at small cars, you look at construction equipment, the smaller ones, the backhoe loader equivalents. So I think all our LCVs, I think we're seeing kind of demand for all of these products in that market, which gives us a lot of sense that even the consumers are betting on the next 3 to 5 years is good 5 years time. And therefore, I wouldn't say it's just election. I think it's activity out there, and I'm seeing, at Gram Panchayat level, there are infra activities, at municipality level, there are activities. So I think the rural is more driven by the local activity rather than one large decision that needs to happen.
Yeah, but so that set of lending, or that kind of lending you've been doing now, at least for the last 7 or 8 years that I've been tracking you any which ways closely, do you, to use that cliched term, is this time looking slightly different?
So what looks little different this time, at least for us more particularly, is we have gone even more deeper than we were maybe 5, 7, 8 years back.
In the sense?
So we are in more villages.
Okay.
Right. So we were covering, let's say 7 years back, we would have been in 200,000 village. Today we are having customers in 330,000 village, which means is there more customers coming out to buy these kind of assets? And are they being bought in villages where possibly earlier this buying was not happening? So is that a new segment of customer that seems to be happening out there? I would think is, while 5, 7 years back, we would have thought there'll be more competition. I don't think we still see much competition for us as a player into those deeper pockets. So that makes us even more responsible to go lend and open branches to be locally available to start recovering from that market. Right. Our own knowledge has gone up substantially to understand under what circumstances will we act very differently from the way we should act normally. Right. So I think that's an experience over a period of time. So I would put all of this together, our own knowledge going up, deeper penetration, ability to bring in new segment of customer to the market, and every OEM is reaching out to rural market, which means the product demand or product competition is so high to choose from that every product gets sold, and if we are a partner for every OEM out there, then that's another growth story for us, clearly.
Interesting. A lot of your peers, I mean, I'm not necessarily saying companies in the rural area, but in the consumer lending area, let's put it that way, are now being spoken about as a pseudo technology company as well, right? Analytics, and using that in a meaningful way to be able to cross-sell, which is a big part. Now, does it become difficult for you because of the nature of your customers to be able to do that, or are you starting to rely very heavily on analytics in a market which is not as defined and on a run rate which is as consistent as what a salaried customer would be?
So, did we never use data in the past? I think the answer would be we did. But was there enough algorithm, technology support, etc. available to use data more meaningfully, I think today that's possible.
It is?
But our belief has been, it's not just data, right? I think it's extremely important that when you have a data and you have an output, you must be able to read that output correctly. So you need to have adequate knowledge about what are you reading. So I think data plus knowledge is what is going to make all the difference. Now, data many people could have. How many of them will have knowledge already? So our 20-25 years of existence in that market, 6 million customers that we have interacted with, could make one big difference. I think the second is, I think all of this technology, data analytics, etc., is still telling you how to lend. I'm not too sure that it's teaching us the method how to recover when there's going to be a different times, right? And that's where comes your physical presence and your understanding of the market. So our belief has always been it will be a brick and click model. It will not shift from brick to click completely, for sure. And it's not going to be a non-interactive business, because at the end of the day, the customer does not have a fixed cash flow.
Sure.
What if the season fails, a crop fails? What if some infrastructure collections delayed for the customer, right? He's not going to then be able to pay you while the data would have told you something.
True.
Right? So I think we need to take into recognition all of this factor and then use it appropriately.
But are you confident that for FY19, I don't think we can call 2 years out onto asset quality, but FY19, the way you see things, would things be materially different and materially better on the asset quality and the recoveries than what has been an average, say, for the last 3 years?
So if you look at just last 1 year, over the last previous 2 years that we went through, I've run this business now for almost 25 years. I've never seen the 2 years that I went through ever before the first 23 years. Right? But the last 1 year, every quarter has been a great improvement. And the last quarter of last year was our best performance ever in the history of MMFSL. So I would think, and we moved to 90 days. On a 90-day basis, we could correct our gross NPA by 3 or 4%. Right? And I very strongly think that the worst is over possibly, and we're seeing corrections happening both on the growth as well as on the quality.
Because of the preceding 2 years to the last year, do you sense that recoveries are not normally V-shaped? They're more of a U-shaped kind of a recovery, and then the hockey stick may come into effect. In your case, could it be a V-shaped recovery, asset quality, maybe even growth because of the tailwinds that the rural sector is undergoing?
So clearly in rural, what we have seen, when there is growth, the collection improves. Because that's the underlying truth that the cash flow is doing well.
True.
Right? So when somebody is investing 25% margin for a new vehicle, someone who's already having a vehicle is also able to service this better. So first of all, this two goes hand in hand and they go together. And clearly we see that when the things start to improve, people won't even come and pre-close loans. You must understand the customers are not intentional defaulters. They are circumstantial defaulters. They are available to be met and discussed as to what the problem is. And therefore, when things change, they do come back and even pre-close or settle all of the loan. So our credit losses historically has never been very high, even though gross NPAs have been higher.
Yeah, you said
so
this in the
therefore,
past.
to that extent, if you kind of look at, will it be kind of a U moving to a hockey stick, or it's a V and then sharp curve up, I would think answer is yes.
The answer is the V.
Yes, because you will recover something of the past along with doing well in the current.
Yeah, and by the way, so as we discussed earlier, that it's not necessarily only due to the election push, but we have to admit that the election push would lay a larger emphasis on the infra spend across the country, save for maybe 1 or 2 states. I was reading the note that I think the Nomura brokerage has put out on you post maybe a investment forum that you attended in Singapore, that the infra push, save for a state like Tamil Nadu and a few others, is the strongest that you guys are seeing in the last few months, years, as the case may be. Does that aid growth meaningfully in FY19? What is it that you would pencil in as a gut feel, if not an actual number, that you might clock in FY19?
So I think the normal growth, if it is 15-20%, and if the election year or election state, the growth could be higher by another 5-10%.
Okay.
But it's extremely important that election-based growth, whenever a customer comes in and buys assets, he buys it also for a very shorter cycle.
Okay.
He doesn't take it for 3, 4, 5 years, because he knows he takes an asset, gets some job, and can really release the asset in less than 1 year, 18 months time. So you have two types of customers there. One who are traditional into that business. a contractor, a truck operator, a local vehicle user, right? They're traditional who have only been in that business. They normally take a 3 or 4 year loan. Someone who comes in because there is an emerging opportunity, they have some money to invest, they want to participate in that, they normally come in for shorter cycles. So while the disbursements growth could be higher, the book also runs off very, very fast, right? But then you kind of grow and make the money during that shorter cycle of 18 months to maybe 24 months.
So some numbers that you can share with us. What do you believe FY19 could be, growth, asset quality?
Difficult to put a number, but I can tell you that we are gaining market share for all product. And I can tell you last year we grew at 18-19% and the vehicles were continuing to have discounts. And for the same volume, therefore the disbursements were low. So if you were to sequentially look at that the volumes stay where it is and we gain some market share, that's fine. But if the discounts were to vanish on the product, that itself will give us another 5% growth.
Do you think that that could happen?
I would think from festival season one can expect to happen. I think clearly heavy commercial vehicle, there is absolutely no inventory. And therefore that could be the first one where surely the discounts should not be as high as it was even a year back. And then maybe a price increase kick in after that. So if you sequentially look at volume still same, but discounts vanish and then price increase comes in, that itself is a good growth for the same volume. And then if the trend continues and the volume picks up, that could be another growth. So I don't want to put a number, but we are very, very confident when we write out our strategy, this is the sequence we are taking.
Well, there are almost 2 or 3 triggers to that in FY19 itself.
Yes.
And an improving asset quality.
Yes.
Okay, all of that should augur well for MM Financial in FY19 at least, if not more.
I think that's the reason, even in the difficult time, we invested in our people. And last year, the fourth quarter, if you see, we have actually added 100 branch. In one quarter, we added 100 branch. They have not started producing in that quarter itself. So they would all produce in this. And we have a direct marketing initiative where we're reaching out to our existing customers in this 330,000 village. And through them, we are generating business. Not that they buy another vehicle, but they are able to give us an inquiry in that market. So 15 to 20% of the business that we do monthly is self-generated by us. So that's a big strategic differentiator when it comes to, when we go to a dealer, why will he use us versus somebody else, is a reason that we are able to bring business to dealerships.
Okay. I have so many questions more. I can't ask them all. Just one last question, Ramesh. Off business, you have the pulse of what's happening in the rural economy and how monsoons are shaping up as well. There is a Met department, there is SkyMet, but you have the on-ground checks as well. As per plan, you think? And would the season largely be a normal season?
I would think at least my feedback from the branches is that it's on time.
Okay.
What we would wait for to see is it widespread? It's not about on time and just in few locations. It has to be widespread and it has to be in relevant states, the big ones, Maharashtra, MP, UP. If they get adequate monsoon, I think it'll be a great season.
Okay. Touch wood for the economy, for the farmers at large, it should turn out to be well. So hoping for that. Ramesh Iyer, thank you so much for joining in today. A different conversation that I wanted to have. I'm glad we could have this. Thank you so much for taking the time out today.
Thank you.
Okay, so that's of course M&M Financial talking about their numbers. To the next big thing, and that is Infosys 25 years. Now, we're speaking to the man who was the underwriter to the IPO when Infosys got listed 25 years ago. And the history shows that Vallabh Bhansali had bet on the right horse. I caught up with the market veteran to find out what he makes of the IT outsourcers' journey over the last 2.5 decades under 6 CEOs. Here's a small slice from that conversation.
We feel that we had betted on something very good. Answer was yes. Had we betted on something that was of national importance? The answer was yes. But that it would multiply thousands of times? Clearly no.
Yeah, but I mean, it's one thing to envisage the size that it could become, but two is to try and, know that what you are doing is something that will become really, really big. One in terms of size, in two in terms of revenue, three in terms of the kind of prestige that it demands from investors and corporates alike?
Clearly no. And I must say that not because Mr. Murthy looked less, person with any less potential. He looked tremendously tremendously different, thoughtful, full of possibilities, etc. But we didn't know India that time.
Okay.
India had just started to open up. And how things would pan out in that atmosphere was very difficult to imagine. And but for that, I would say that we did think that Mr. Murthy was an extraordinary person, that the field itself of IT software services had huge potential, that whether it would continue to grow at 25% compounded for 15 years and then another 10% and now another, it's continuing at around that 10% clip. That was not possible. But given our own maturity at that point of time, given the status of the country, the state of the country, it looked exciting.
Do you think embedded in your answer was the freedom being given to people, to thought leaders, etc.? Do you think Infosys has managed to do that over the last 25 years, which has allowed it to expand so much?
Also, I've said this before, but I think it bears reputation, that Infosys played a very important role in bringing out the significance of freedom given to a businessman.
Mm-hmm.
Just imagine if we had not had a leader who was absolutely shining, glistening in values, in ambition, in vision, in innovation, in shareholder value management or value creation and then shareholder expectation management, etc. Maybe without that totem pole, we would not have had such an exciting time. So not only that Infosys became a great company, but Infosys became a great torchbearer of freedoms used correctly. So I think there's a great value to Mr. Murthy and Mr. Narayan Murthy and Infosys.
Okay, interesting you say that. So does the Infosys currently, and this is no bearing your thoughts on what the current leadership at Infosys would be. I'm just trying to get a sense because of the fact that what Infosys used to do maybe in the 1990s to 2000 decade, which is a lot of firsts to its name, the first half-yearly results, I believe the first quarterly results as well, the first audited set of numbers, etc., etc. Now we have a lot of companies who understand the value of doing, in quote-unquote corporate governance in the best possible way. So is it difficult for an Infosys management now to carve out such firsts for itself in what is arguably a lot more crowded marketplace than what was back then?
Infosys benefited from having a set of extraordinary people at the same time, the founders and then Mohindar and people like them, and therefore their innovation shone brightly for the lack of innovation in other places. But it can still happen. It can still happen.
Okay, you sense that at all? Because for example, this decade, Mr. Bhansali, and again, not casting a shadow of anybody's leadership, etc., but the Infosys of 2011 to 2018, at least in terms of the kind of growth that it has shown, lags far behind. Until 2010, I remember as an analyst and as somebody who used to comment on individual companies on air, Infosys was the unequivocal poster boy of Indian IT. What Infosys said used to happen for the sector. That mantle has now been taken by other companies as well. Is it that Infosys missed out on doing a few things right, or is it that other companies did something better?
I think one has to be philosophic about it. That, like men, companies are also mortal. Companies are after all managed by men. And we will have cycles. More important thing to do is to reflect on what was the design that Infosys created. Say, for example, what values were very important to Infosys. There was a sense of egalitarianism, in the sense that the promoters, the founders, did not treat themselves as a super class. They treated themselves as the same with their employees. They did not take super salaries. Mr. Murthy saw to it that the chairmanship of the AGM was passed amongst directors. First his founders and then the directors. So this sense of egalitarianism led to the kind of decision making and succession planning that actually happened at Infosys. Now, only when history will be written, we will see the value of the experiment that Infosys attempted.
Interesting. And
so when you said between 11 and 18 they were not practicing, you know, some of the innovation that they did earlier, or that did not stand out as much as, you know, some of the earlier innovations in the 90s, this is a huge innovation that Mr. Murthy decided to come back, give up very easily, all promoters deciding to walk out, admitting that there was probably an error. Mr. Nandan coming out from his, you know, kind of retirement completely. He had not gone to Infosys campus since the day Vishal Sikka took over. So these are the kind of rishis that they are. These are the practices and the stories that, you know, will get written about, I'm sure. So I think in the history of a company, in the history of a country, 5, 7, 10 years are nothing. But when you think of values, when you practice those values, they play out at different points of time. So I saw when we started the journey with Infosys, we saw the values. We saw their ability to think of detail, their ability to take risk, their desire to be transparent. I mean, the whole transparency story started with the prospectus itself. They're the only prospectus ever written in India, at least, maybe in the world, which said for the next 3 years, we hope to grow at 50% per annum, make at least a 20% margin on it, and declare a 20% dividend every year. At a time when people said, I mean, unmentionable thing, barring unforeseen circumstances, the company hopes to be profitable, etc., and declare a dividend. Come from complete vagueness to complete specificity. I think so there is a whole lot of value system that has been instilled, values vis-a-vis employees, vis-a-vis customers, vis-a-vis shareholders, vis-a-vis management. And I think between 11 and 18, the importance of Mr. Narayan Murthy is taking up the issues in a bold manner. A lot of people got irritated. Someone very ridiculously said, "Old man, go away." What are they telling? They are talking about, don't be inconvenient. Don't ask uncomfortable questions. Don't upset the apple cart. That's not how Infosys gets created. So a lot of those things are, you know, alive and kicking, and they're being handled in a very mature manner.
Interesting. I have two follow-ups to that, Mr. Bhansali. Firstly, about this, whether the landscape right now permits itself for companies to be able to come out and give that vision that we want to grow at X percentage over the course of the next 4 or 5 years, or whatever, 10 years, as the case may be. And two, at a time when a lot of world leaders are now weighing in on why is it that companies need to give guidance? I mean, Warren Buffett was on record saying that it might be detrimental to shareholders if companies come out and give guidance. Where are you on this whole argument, specifically for IT companies, because they were the ones who actually started off giving, or Infosys essentially started off giving guidance quarter after quarter?
Firstly, Mr. Buffett is about quarterly guidance. He is asking CEOs not to get away from guidance if they chose to give, but to go away from quarterly, because that's not how you manage, that's all. Okay. So I think the second, I think it is, all times are difficult for those who do not know how to manage them. All times are easy for those who know how to manage them. And when you are transparent, it's not about spectacular growth. It is about just saying that, look, this is how we see the landscape, this is how we are going to navigate, this is the result that we hope to obtain. And this is classic management. If a management does not have objective, which it pursues, and then it wants to be opportunistic, then, you know, as people say, oh, everyone is a visionary in retrospect.
Said that you're not as closely associated with Infosys as you were in the past. But as I said, we respect both sides of the opinion, right? So I saw that piece that you had written, I think last year or the year before last, wherein you mentioned of you being in Mr. Murthy's shoes and how would you think. My question to you would be, sir, that Infosys here on, I mean, whenever there has been a problem of sorts, let's put it that way, we've had one of the founder members who has built this company come back, steady the ship and then move on. Can the Infosys over the next 25 years or the next 5 years or the next 10 years, I don't know what kind of vision what anyone would have, move ahead without how do I say it, without the founders coming back at the first sign of trouble, so to say? I'm not saying it's a bad thing or a good thing, but...
Let us understand what Mr. Nilekani has done. Has he brought a founder magic as such back to the company? No, I think the founders have left systems and values in the company so deeply entrenched at various levels that he doesn't have to recreate any of them. I think there was issue at the board level at Infosys, and I think which needed fixing. The board needed better leadership primarily. And I think Nandan has brought that board level leadership. The board is still undergoing some changes. And second, I think Mr. Murthy had nothing against Mr. Sikka as much as against the board. As I wrote in that article, that it is the job of the CEO to be enterprising. Sometimes he'll make mistake, he will overreach, etc. But the board cannot just eat out of his hand or her hand. So the board fails to do that. If the board is not educated, board is not hardworking, etc., etc. I think that was the issue. So I think the founders will not be long enough, how much ever, I wish that, they be here forever. They won't be here, so the company will have to learn. And the company has enough of their legacy, enough and more of their legacy to really build on. And I hope that Nandan is there long enough to rule out the need for any such further intervention.